One of the coolest aspects of real estate investing is just how complex and creative the financing structures can be that are utilized to purchase properties. So I'm going to go through some of the basic, more intermediate, and a little more advanced ways that financing can be utilized to purchase anything from single family to a 500 unit apartment complex. So let's start with the basic types of financing that are utilized. Now, the most simple type of financing, and the one that everybody should be familiar with, but don't feel bad if you're not, is a conventional mortgage. Now, conventional mortgages come in two different forms. They come in fixed rates or adjustable rate mortgages, or ARMs. Now, for all of these types of financing that I'm going to talk about under the basic level, the term is going to be 30 years. So you're going to have 30 years to pay off the balance that you're borrowing, right? So on a fixed rate mortgage, you're going to lock in a fixed rate for that entire 30 years. That is in March of 2023, what it is right now, it's probably going to be about 6%. So you're going to be paying 6% interest compounded monthly on that mortgage for the next 30 years. Now, an adjustable rate is typically going to have an intro period of 5, 7, maybe 10 years. Now, what does that mean? Well, ARMs are similar to fixed rates, but the benefit that an ARM has over a fixed rate is that you can typically get a lower interest rate for the introductory term. So if a fixed rate mortgage is offering, let's say 6% today, you might be able to lock in an ARM at 5 3/4 or 5.8%. But how does that introductory period work? Well, let's say you get a 5-year ARM in 2018, so 5 years ago. 5 years ago, you might have signed and closed on an ARM for, let's just say, $300,000 at 4% interest, right? So for the past 5 years, you would have been paying 4% interest. Well, today, with interest rates at 6% and your ARM, your introductory term, expiring, that rate is going to be adjusted up to the current market rates. And it will be readjusted every year on an annualized basis until the end of that 30-year term. So 5 years later, after paying 4%, your interest rate is now going to jump up to 6%, which is going to be significantly more of a payment than you were paying 5 years ago. But again, the benefit to an ARM is that you can get a lower rate for that introductory period. Now, for both of these types of financing, you're going to have to bring between 20 to 30% down. It accounts for both. So that means that if you are borrowing, let's say $100,000, we'll keep it simple, you're going to have to bring between $20,000 to $30,000 to the table of your own money in order for that lender to give you that financing. Also, to qualify for these, you're going to need to have a decent credit score. The lender's going to check your credit history. They're going to check your current outstanding debt or your debt to income ratio. And they're going to want to verify your income to know that you are making enough money to cover that monthly payment. But what if you don't have 20 to 30%? Especially, given when in 2022, the average American savings rate was about $61,000, but according to the St. Louis Fed, the median home sale price was around $450,000, which is certainly not 20 to 30%. How are you going to buy that type of property? Well, the Federal Housing Administration, or FHA, came in and said, hey, Americans, we know it's difficult to save up that money. And, it's difficult to have strong credit, right? So what we're going to do is insure your loan and require only a 3.5% down payment. Now, 3.5% is a lot more doable than 20 to 30%. Let's use that same $100,000 example, which, by the way, you're not going to buy a house in 2023 for $100,000. But hypothetically, let's say you were, right? At 3.5% down, you're only bringing $3,500 to the table to close on a property worth $100,000, which is a great deal, especially when you're considering that you don't have to have as strong as your credit history, and you might not necessarily have to have as much income, right? But what's the trade-off with that? Well, with an FHA loan, you're going to have to pay PMI, or private mortgage insurance. This is going to be a monthly fee on top of your PITI, or principal, interest, taxes, insurance, that pretty much goes to nothing. Which, if you're buying a property as an investment, money that you're giving away that has no purpose kind of sucks to pay, right? But it's a great way for first-time homeowners who might not have that much money saved up to buy their first property. Now, another type of down payment assistance, or another financing structure that utilizes down payment assistance, is a VA loan. Now, this stands for Veteran Affairs. Now, what's super, super cool about these loans, besides the fact that they're for active service members or past service members or their spouses, is that it requires you to bring 0% down, which is pretty freaking sweet. And on top of that, you don't have PMI. So VA loans are awesome. Now, you can have 2 of these loans open at a time. With an FHA loan, you can have 1 at a time. And with a conventional mortgage, you can have as many as you want open at a time if your DTI, or debt to income ratio, will cover it. Now, the fourth basic type of financing that is utilized to buy real estate is a DSCR loan. Now, DSCR stands for Debt Service Coverage Ratio. These loans are utilized by investors who are in real estate full time, since they more likely than not don't have a W-2 to have the income verification needed to get a conventional mortgage. A DSCR loan depends more on the property than it does on the borrower. So how you calculate DSCR is by taking your net operating income, or NOI, which is just your income minus expenses, excluding financing, since it's not the property's fault, you need financing to buy it, over the debt, or the annual debt, right? To get a DSCR loan, at the bare minimum, that property is going to need to be able to generate a 1.2 debt coverage. Now, you can't just go get a DSCR loan because you found a property that can generate cash flow, right? They're also going to look at the borrower's credibility and past experience to see if they can manage that asset. But similar to conventional mortgages, you can have as many of these DSCR loans open at a time as you can qualify for. All right, so now that we've covered some of the basic methods, let's get into some of the more intermediate methods of financing. Now, these are going to be used by a little bit more sophisticated of investors, or individuals who already have a property or several properties and are in a space where they can leverage that to buy more. So we'll start with bridge loans. Now, a bridge loan is just what it sounds like. It bridges the gap between 2 transactions. A common example of where you would use a bridge loan is when you are selling one property that is set to close, let's say, a month from now, or that is set to close, let's say 3 months from now, but you're buying another property that is set to close in a month. Well, you need the funds from the close of that first property to buy this new second property. But because you're not going to get it for another 2 months, you have to obtain bridge financing to bridge the gap between these two purchases. Now, to get bridge financing, you're going to have to bring a decent down payment or have significant equity in that property, in the first property that you're looking to sell. It's going to be a higher interest rate, and it's also going to be a shorter term loan. Now, another shorter term type of financing that also sounds exactly like what it is a construction loan. Now, a construction loan is used for rehab / construction, right? Similar to a bridge loan, you're going to either need to have significant equity in the property that you're doing this rehab to, or you're going to need to bring a significant down payment. Also, just like a bridge loan, it's going to be for a shorter term, typically a few months, a year, maybe 2 years. And you're also going to be paying a pretty high interest rate. So let's talk about another type of short term. Well, it can be short term, it can be longer term as well, but typically a shorter term type of financing, and that is a HELOC. Now, HELOC stands for Home Equity Line of Credit. Now, this is when you have a property that you have equity in. Let's say maybe you owe $100,000 on it, or let's just say you own it. Let's just say you own a property free and clear, right, for $100,000. It's worth $100,000, right? Well, a bank might give you a line of credit worth $70,000 that you can draw from to use as needed at a set interest rate. Now, that interest rate is going to fluctuate around the prime rate, which is going to be a few bips above the federal fund rate. And HELOCs are typically used similar to bridge loans when you need to cover a cost in the short term when you're expecting to either refinance or have significant cash flows come in later that will allow you to pay off that HELOC, since you're going to be paying monthly interest while you are utilizing that line of credit. So I'm just going to write line of credit. Summarize that for you guys. All right, so another type of mortgage, and one that I am not very fond of and seems somewhat criminal. I could definitely be wrong, but just from my experience and the individuals that I have talked to who have used this financing, or the individuals who are stuck with a property with this financing after a loved one passed away, is a reverse mortgage. Now, a reverse mortgage is somewhat similar to a HELOC, where you are getting money from a bank based on the equity in a property that you have. However, with a reverse mortgage, you're not making monthly payments. Well, sometimes you are, but typically you're not making monthly payments on it to start. And you're going to receive all of that equity as either a lump sum, or the bank is going to pay you monthly payments on the equity of that property. Now, in exchange for that, you are going to have to pay them back with interest at a later date, or what is more common is the bank is going to wait for the homeowner to die, and upon their death, they will foreclose on the property and assume ownership, then either sell it off or convert it into some other type of asset. These were really popular in the 07, 08 crash, or I guess more specifically 06 to 07, because obviously the crash came in 08. But in 06 and 07, because home prices had inflated so much, homeowners could cash out their equity. Like, let's say they bought a house in 2002 for $20,000, and in 07 it was worth $300,000. Well, they could cash out that entire $300,000 as a lump sum, maybe less, but they could cash out a significant portion of their equity without having to sell their house and without having to make immediate payments on it, depending on if they took it in a lump sum or if they took it in payments. Now, another type of mortgage, or not mortgage, but another type of loan, it's a little more hands-on with the bank or the lender, is a portfolio loan. Now, a portfolio loan is a loan that is held by the originator for the entire term of the loan, meaning that it is not sold off into the secondary mortgage markets to firms like Fannie Mae or Freddie Mac. You're typically able to get better terms on a portfolio loan, and they're a little more lenient on your credibility, but you're probably going to end up paying a higher interest rate as a result of those terms. Now, let's talk about the financing methods that don't involve banks. So all of these are financing structures that you can utilize when you go to a bank. But two of the intermediate financing methods that don't involve banks are hard money loans, which if any of you are in the real estate investing space already, you have of course heard of hard money, and private money. Now, these are very similar in the sense of who they come from and how you get them, but their true difference is in the term. So a hard money loan is going to be a short-term loan, few months to maybe 0 to 1 or 2 years, right? So a few months, maybe up to 2 years. It's going to have extremely high interest rate. Like, let's say today, the conventional mortgage rate is about 6%. If you're getting a hard money loan, you might be paying like 15 or 17%, which is, extremely high. But these types of loans are utilized for flips. These are only utilized by investors. When you're buying a property, let's say for $200,000, and you're going to put $50,000 into it and sell it for $350,000, well, you're fine paying 15% interest on that $250,000 for 2 months, because at the end of those 2 months, you're going to sell that property and get $350,000. So you don't have to go through all of the red tape and credibility checks that you have to go through when you're getting conventional financing, because it really just depends on how much equity you have in the property. Now, private money is very similar to hard money in the sense that it isn't coming from a bank, but private money is typically going to be for a longer term. Now, when you think of private money, what is typically thought of is the rich uncle, right? So private money is when you're going to go to family, friends, or maybe somebody who just is a private money lender, and they are going to give you access to capital for whatever terms specified with whatever terms they want. But you're not going to have to go through that same credibility check. You're not going to have to go through all the red tape, pay the origination fees. If you're doing an FHA, pay the PMI, all these different things. It's just a simpler type of financing because you're not going through a bank. So these are short-term financings from a bank. These are longer terms, but they're a little more aggressive. And then these types of financing methods are from private money lenders. They're not coming from a bank, but you're going to pay a higher interest rate to get them. All right, so the third type of financing that I want to talk about is creative financing. Now, creative really just means that you are not going to a bank, and it is not a traditional route, but it doesn't mean that it's not used. Creative financing is utilized all the time, especially right now in the current economic environment. So there are two kind of main types of creative finance. There is seller finance, And then there is subject to financing. All right, so under seller finance, we're going to have three different categories. We're going to have a land contract, a lease option, and a owner carry or a carryback. So with a land contract, you are going to pay off the purchase price of that property in installments, or similar to how you're going to pay off a mortgage monthly. You're just going to make monthly payments to this seller. However, you do not receive title You don't receive title to the property until that property is completely paid off, meaning that you can't capture the depreciation expenses if you are using that property as an investment. Now, a lease option is similar to a land contract where it involves monthly payments. However, the monthly payments aren't made towards the purchase price, right? So in a lease option, it is a lease with an option to purchase. So you're going to pay the monthly lease that you and that property owner have agreed upon. And at the end of that lease term, you are going to have the option to purchase that property at a specified price. But in order to have that option, you are going to pay a premium to the seller at the beginning of that lease. Let's say it is a $200,000 property and you're leasing it for $2,000 a month. You might sign a 1-year lease where you're going to pay that owner $2,000 a month for that 1 year. You're going to have the option to buy the property for $190,000 at the end of that year. And in exchange for that option, you are going to pay a $10,000 premium up front. Now, if you don't exercise that option, you lose the premium, but it is a way to ensure that you are going to be able to purchase a property at a set price down the line. An owner carryback is basically where you convert the seller into the bank, right? So this is where the owner is going to carry back or hold a portion of the purchase price. Let's keep using this $100,000 house example, which again, you're not going to be able to buy a house for $100,000 in 2023, but let's pretend we can. So if I want to buy this $100,000 house and I can't qualify for a mortgage for whatever reason, and go, hey, Mr. Seller, I can't get $100,000 from the bank, but I do have, let's say, $20,000 saved up now. And I'll give you that $20,000 if you finance the $80,000 to me at whatever interest rate they want. So let's say interest rates are 6% today. I might try to get a lower interest rate on the owner carryback, but it depends on how sophisticated that seller is. But essentially, you are converting the owner of that property into the bank. It really is a win-win because the owner takes in less money up front, meaning they have a decreased tax liability, and they also make way more money over time because they're getting compound interest on those payments. Now, subject to is something that has gotten really big. It's been around forever, but it's really picking up steam right now thanks to Pace Morby, who is he's amazing at creative finance. You guys should definitely check him out if you haven't yet. But subject to is where you buy a property subject to the existing debt. So let's take, for example, I'll give you a real example actually, a property that I have been working on recently. The owners bought the property last year for, I'll just use nice even numbers. They bought the property last year for $1 million and they brought, about 20% down, a little bit less to the table, and they got a 3.5% interest rate, right? Well, now they're trying to sell that property a year later when the market has only gone down and interest rates have only gone up, meaning that people aren't willing to pay that $1 million anymore because it's actually more expensive to buy it at the same price as it was last year. So what an investor can do is come in and say, hey, I don't want to go to the bank and get another mortgage, pay origination fees, get my credit check, bring 25% down. I would rather just purchase this property subject to the existing debt, meaning that I will pay you whatever amount we agree upon. Let's say it's their equity. So in this example, let's say it's, the $1 million property. Let's say they still owe $900,000 on it, right? I could say, hey, I'll bring you $100,000 down, which would effectively be 10% as a down payment. I'll bring you this $100,000 down and let me take over your payments on the million at 3%, because a million at 3 is significantly less than what it would be today. Even if you were paying 900 today, 900 at 6, that million at 3 is going to be a lower interest payment. So that's a way to get into a property by leaving the debt in place. Subject to really just means that you're leaving the debt in place. So when are all these different methods used? Well, typically the more sophisticated of the seller and the more valuable the property, the more complex the capital stack or financing structure is going to be on that property. Now, most single family is bought with a conventional mortgage, FHA, or VA, right? Just because it's basic, it's what people understand. But again, like I was saying, as we get into commercial and as we get into industrial and hospitality and all these other things, the debt structure changes because those investors understand that it's not as easy to acquire that much debt. So there's a lot more owner carryback and there's a lot more land contract. And I mean, especially in commercial real estate, the financing is typically only on 5 to 7 year terms anyways. It's still amortized over the 30 years, but it's a 5 to 7 year term, meaning that you have a balloon at the end of it. Now, I'll, of course, make another video going into how exactly some of these financing structures work. But when it comes down to knowing what one is best for you, it's important to consider all of these different methods like tools in your tool belt, right? You can take them out and use them as needed to get the job done, but there really is no perfect fit. Sometimes it might make sense to buy all cash. Sometimes it might make sense to go get a conventional mortgage. Sometimes it makes sense to get an FHA. Sometimes it makes sense to do subject to, right? It just depends on the deal. Like all real estate, it depends on the deal. So I'll leave some resources in the description below for you guys to do some more reading. And as always, if you have any questions, leave a comment. I'll get back to you as soon as I can. Thanks. Deuces.